Hello there. Good afternoon. Welcome to today's discussion on the private equity Dealscape, private equity and venture capital Dealscape, COVID-19 and beyond, brought to you by the Economic Times and SS&C Intralinks. Thank you all for joining us. Thank you to all the panelists for sparing time for this debate. And thank you to all of you who are joining in to listen. Thanks for taking the time to join us today. In many ways, private equity investments, they serve as a barometer of a country's corporate and startup sentiment, and we will surely see some insights today that will help us understand the current investment scenario. My name is Alokesh Bhattacharyya. I am senior editor of the Economic Times, and I will host today's discussion. Before we start anything, I would like to introduce the panel. We have a very powerful panel here today to take on this subject. We'll just quickly go through a round of introductions. We have Vishal Tulsyan, is the MD and CEO of Motilal Oswal Private Equity. Divya Sehgal, partner True North. Sandeep Murthy, partner of Lightbox Ventures. Ashish Fafadia, partner of Blume Ventures. Sajit Kumar, senior vice president, SIDBI Venture Capital. And we have Alan Chu, marketing team lead, Asia Pacific of Intralinks Holdings Incorporated. Thank you all, gentlemen, again for joining us in this debate today. Before we start, I'd just like to paint a small bit of context. You know, 2019 was really a bumper year for private equity deals in India, as we all know. Investments of anywhere between 45 to 48 billion dollars in India. This is despite the economic slowdown that looked very real even before COVID. The surge was primarily due to rise in number of deals worth 100 million and more, and also increase in average deal size. Seems to be some noise from somewhere, I think. According to a report by IVCA and Bain, sectors that saw high investments during that period included BFSI, consumer technology, real estate, infrastructure, telecom, IT, and ITES. And following the trend from previous years, the share of buyouts increased with the rise in growth and late stage investments as well. But while investments grew, exits actually fell in 2019 compared to the previous 2 years. So, and this year, a report from EY predicts that exits will fall further 50 to 67% from 2019 levels, which is quite a big fall. Investments in 2020 by PE/VC firms are likely to fall 45 to 60%. And while the COVID crisis is not looking to exit, even as PE firms are, one just hopes that 2020 doesn't turn out to be as bad as 2009. If you remember, 2009 was the time when PE investments fell almost 70% compared to 2007. In terms of strategy, we expect EY expects most general partners or GPs to remain focused on current portfolios, just to ride out the COVID storm, play safe, ensure business continuity in your portfolio companies. And GPs are expected to help their companies through additional equity infusions, bridge financing, helping senior management to manage this crisis. At the same time, buyouts are not going to be as hot as they were last year. They will remain on the back burner as PE firms go the capital growth, growth capital route this year, and they try and cash in on the opportunity to deploy funds in strong businesses at attractive terms. And another interesting entity on the horizon is private credit, right, which is also seeing some growth as opposed to private equity. Interesting scenario, lots of interesting trends, and obviously lots of interesting questions to discuss today. But before we dive into the discussion, I would like to invite Alan Chu, who is the marketing lead of Asia Pacific at Intralinks, to give his opening remarks. Alan, over to you.
Sure. Thank you, Alokesh. Just give me a moment. I'm going to pull up some slides. I have some very quick slides to talk us through. Now, yeah, first of all, a big thank you to Alokesh for the introduction and being the host of today's event. And thank you to all the panelists who are here today. I'm very delighted to be alongside with you to share thoughts and insights across Asia Pacific, but with the main focus within India. I'm Alan Chu, the marketing team lead for Asia Pacific at SS&C Intralinks. Intralinks, once again, is delighted to be partnered with the Economic Times of India, and what we know will be a session of open discussion, lots of great insights. And my understanding, Alokesh, is that the Economic Times has not ever hosted an event around alternative investments. So private equity, venture capital, this is a first for Economic Times. So, it's something very unique, something very interesting for our audience today.
Absolutely.
As the partner of the event, I'd just like to take a few moments to introduce who we are. So I'll use that in the next slide, and why we're relevant to today's listeners. We are Intralinks. We are essentially a platform which allows the secure exchange of documents to facilitate strategic transactions. Our core offering is the virtual data room. So that's something we've had for 20-something years. It's something that bankers, advisors, managers across the world have used. But we've also, in recent years, introduced a whole suite of other products, such as deal marketing, Deal Vision, which is a buy-side due diligence platform. All of these things ultimately to facilitate transaction, to make life easier for managers, bankers, and advisors, in terms of security, in terms of efficiency. And I think the numbers speak for itself. We are part of the world's largest provider for assets under management. And one statistic I really like is right there in the middle, where it says more than $1 out of every $2 raised globally was done using an Intralinks platform. Right, so it goes to speak the volumes of which this has been involved in fund managers and LPs' lives, over the decades. This, has seen a lot of growth, especially in Asia. I know our market penetration has improved a lot in India over the past few years. So, it's something that, GPs and LPs are demanding worldwide, and a lot so in India as well. Now, we've been around since, the mid 1990s, but our presence in India started in 2003. And since then, you'll see on the slide there, we've got about 23,000 employees worldwide, and 5,000 of those employees actually sit in India, right? So almost a quarter, and in between, a fifth and a quarter of our employees worldwide sit within India, which again, illustrates our commitment to the region, the company's impact within India itself, and just basically how it's a far-reach community where a lot of experts in the local market rely on. Now, before I hand it back over to you, Alokesh, I just wanted to take this moment to introduce you to two of my colleagues, Mayur, who is the sales director for India, as well as Rohan, who's an account executive specifically for our alternative investment clients. Now, both Mayur and Rohan, great friends of mine. They're based in India. I'm based in Singapore, but they're based in India, so they'll be able to help answer any questions. I've left their phone number and the email contact over there. And any questions you have, anything you'd like to learn more, even if it's a demo, you can reach out to them, and they'll be happy to, I'm sure, walk you through something or just have a general chat. But that's all I had. Didn't want to take up too much time. Happy to turn it back over to you, Alokesh, for the panel discussion for today.
Okay, I sometimes tend to forget that I put myself on mute. Thank you, everybody. Thank you, Alan, for that opening note. And yeah, quite interesting. $1 out of every $2 is invested through an Intralinks platform. That's not bad. That's quite good going for you. Great. So let's take now to the first question for the panelists. And quickly, if we can just discuss a little bit about the market sentiment in India. What was the sentiment that you sense in terms of investments? Data is showing that, of course, investments are down, like I said, earlier. But are the VC firms, are they keeping enough dry powder for India? Exits are also down. IPO market is not very predictable. Macroeconomic projections are very dismal. Q1 was really bad. And the overall fiscal projection is minus 9.5%, which is quite, disturbing. And so overall, the market sentiment does not look very good, even though the last couple of months have been slightly better, and we have seen re-emergence of growth in some quarters. But I'd like to just take this question to the panel and understand from them, what is your sense of the Indian market currently? And this is open to the panel. So we could start with Vishal.
Great. Thank you very much, Alokesh, and thank you for inviting all of us for this interesting panel discussion. I think Alan mentioned initially that, or someone mentioned that probably Economic Times is holding this for the first time. So let me start by sharing that private equity kind of investing is there long-term in nature. and anything that is long term is boring, and that's why probably not very interesting to cover. But uh, but I do believe that any structurally any country, and particularly a country like India, can be built with private equity money. The amount of private equity money that has flown into this country over the last 20 years, the kind of job creation, because at the end of the day, we are a country with limited capital. As a country, we are with limited capital, and that capital is extremely important for growth of the business. So from that standpoint, I think private equity has played a pivotal role over the last 20 years in terms of growth of Indian economy. Coming to your question right now, Alokesh, clearly pandemic has hit the business. So you spoke about markets. Stock markets is obviously not showing any sign of distress, right? The markets are higher than what it was pre-COVID levels. In fact, few of the IPOs that have happened in the last 4 to 5 months, you've seen a bumper subscription there, and in fact. Without naming anyone, some of the valuation that people would have been willing to give to some of the companies would have been maybe 30-40% lower than the IPO valuation, and the current market price for these companies is probably 1.7 to 2x of the IPO price itself. So clearly market is not showing that. As far as businesses are concerned, they have been impacted for sure. I think across the board, businesses have been impacted. There are certain pockets of businesses, either it could be online or it could be essential, where one has seen a positive traction, but otherwise across the board, businesses have been impacted. But the impact on the underlying businesses have been a lot lesser than what one had expected. I remember when in the month of March, we were all made to sit at home, and we were trying to put together what our businesses are going to look like in the next 12 months. Probably we were of the view that across the board, almost all of our companies will see a 20 to 40% reduction in sales, and maybe a higher proportion in terms of profitability. But the only thing that all our companies have to ensure is to have a better balance sheet as on 31st March 21 than what it is on 31st March 2020. So if you remain solvent and if you have a superior balance sheet, probably you'll get enough opportunity to not just recoup what you have lost, but also do better, because there are going to be other businesses which will not have a superior balance sheet, and they will stand to lose.
So as an organization,
7 months down the line, 7 months down the line, when we look at the performance of our underlying portfolio company, and this is the sense that we get when we talk to our peers and friends in the market as well, things are not that bad. In fact, the reduction that I'm talking about has been a lot lesser. In fact, there are few businesses that have done better than what they did last year, and the cost across the board has come down. So profitability is better. Balance sheet is in fact superior. Working capital has become better than what it was last year. So it's been, while the businesses have been impacted, I think superior running businesses with stronger balance sheet, have done better in the last 6
so
months.
you would still be bullish in your sentiment towards investments in India?
Sorry?
You would still be bullish towards your investment sentiment?
On a lighter note, we don't have a choice but to be bullish on India. But on a serious side, I don't think such situation will really change our investment philosophy as far as India is concerned. Clearly, some of the sectors could get impacted more in terms of medium term.
Okay.
Some fundamental changes are going to be there in some of these businesses, which we'll have to see differently. But overall, I think as a country, I think so for example, financial services has been one of our focus sectors, and that's one sector that one is talking about quite a lot. I think we continue to remain very bullish as far as this sector is concerned. Yes, people will take a little bit more hit this year than the earlier years, but people who are very well capitalized, I think should not have reasons to worry. And in the medium to long term, I think lending as a business is here to stay. So yes, we have been and we will continue to remain very bullish.
Very positive note to start off with. Let's see if the others also share your view. Divya, you want to go next?
Sure, Alokesh. Happy to share our thoughts. So I would resonate some of what Vishal said. From our perspective, we are in, most of our investments as a private equity firm are with a 5 to 7 year point of view, right? And in fact, if I circle back, every crisis we invested in, those investments have turned out to be among our best performing ones. So if I look at financial services,
This is
which
one
was
of the
quite
aspects I'll come to at a later point.
sure.
Let me say it.
And we can give some examples, but we did some investments in the 2017 beginning demo impacted timelines, and those are turning out to be quite well. So that sort of is the overall theme. But I would say this, that when we do these long-term projections, there are two things we look for: the next 12-month projections and the 5-year out forecast. Sort of the 5-year out forecast helps us understand the industry attractiveness and what the business can do in the medium to long term. But the next 12-month forecast helps us understand what's the volatility and predictability in the business. The point being that we are not a venture fund, we are a private equity fund, and we would like to come into businesses as they start maturing a bit. And the challenge we have in these times is obviously, as you can guess, when on GDP forecast, people have varying measures. For us to sort of do forecasts on the underlying revenue streams, forget profitability, is challenging. So I would say then sharply to your question is that a few sectors which are less impacted and where it is relatively easier to see the future, I think are the ones where we are perhaps spending more of our time than some of the sectors where we need to understand this a bit better.
Okay. Interesting. Sandeep?
Sorry, yeah. Hi. So, look, we're an early stage venture fund, or I would say mid stage to that extent. I've been selling the India story since 2005 to people, and anybody who's been willing to kind of buy into it. We've been talking about the fact that it's coming, it's coming, it's coming, it's around the corner. I think that, especially in the tech world, what's been happening is it's been a process of gradually and I really think that while COVID has definitely had an impact on businesses from the mindset of how they were operating before, even pre-COVID, we started to see a lot of adjustments take place to how tech businesses were being looked at. You had seen companies in the US like Casper go public, where their public valuations versus their private valuations were radically different. Their last private round was around 1.2 billion. By the time they went public at 400 million. So you started to understand that public markets were thinking about private companies very differently than other private investors were willing to. And so already we had started to see some course corrections starting to take place. COVID now accelerated that to an extent of saying, listen, unit economics matter. Divya mentioned that, looking at below the revenue line. I think everybody had to learn that there were line items below that and start to reacquaint themselves, in my world at least, around the fact that profitability, unit economics were going to be important. And I think that that's a lesson that's going to stick and stay, and it's going to be healthy for the overall ecosystem. The burn endlessly chasing growth. There's a saying that says growth for the sake of growth is the ideology of a cancer cell. And to some extent, that was really what had been being pursued around the tech ecosystem. And I think now today, if I look across the portfolio companies, you mentioned some of the recoveries coming back in the last month or two. What's coming back is also healthier businesses. So businesses that are no longer looking at customer acquisition costs at levels that were unsustainable. So you're getting a better picture. So now all of that combined with the idea that the fundamentals of a large population that is relatively young, that is going to grow in economic prosperity, hopefully over time, still represents a very interesting and exciting market. So I think that, yes, exits are going to be impacted. Yes, these challenges have existed probably for the last 15 years, at least since I've been telling the story. We've seen green shoots from time to time of things changing in that. I would be hopeful that the next 4 or 5 years will show a more consistent path towards businesses being able to scale and profitably exit. So, of course, yet again, you have another person who is bullish and positive on the market.
Yeah, as a journalist, I'm always looking for negativity. So I'm going to move to the next two guys to see if there is something there. Sajit, what's your view on this? Is your market sentiment still positive about investments?
How I see, I've seen two earlier cycles also, post.com burst and 2008-9 crisis also. And this time in April, everything was shut. I think March, April, everything was shut. Post that, something started moving, and people started finding a ways to work out and adjust. And I think by the quite a few, the better ones, cash positive ones, could adjust and move on, and in fact do better businesses. And surprisingly, some of the tech businesses did. I mean, surprisingly, what tech businesses, particularly who had shifted work from home entirely,
Right.
were doing very good and developing a lot of technology. Productivity had improved on the technology. The downside was on the sales side. Sales side was not picking up as much. So overall, see, the long-term sentiments remain positive for us. And what I gather from whatever I've seen over the last 6 months, this situation doesn't seem to be that bad as the 2000 .com one, where you didn't find any entrepreneurs to take the risk. And in 2008, there was no money, even if the entrepreneurs were there. So that sentiment is not there. I mean, it is better off. But there is slight disturbing data which is floating around. Like in the US, yesterday, I was just, today, I think, morning, I was reading a Times article, wherein they are referring to three waves of this pandemic. In April, they had a peak of 23, where the infection rate was 9.7 per lakh. And July, the second wave, it was 20.5 per lakh. And today, in October 24, they reached a peak of some 23 per lakh. And even the total count of infections have increased. And they're just not very clear about the winter season also. So this kind of data in the Indian scenario also, how it impacts, does it put under brake on? That's all. But in the long term, this is a demography where we are positive about overall. There'll be hiccups. We have seen hiccups in 2008.com. This could last a year and a half, those hiccups, but it will recover, and there's always demand. And yes, like I would agree with Divya. Some of the best investments get made in this market.
Yeah. Some of the best investments do happen in,
Yes.
like war. Always, every crisis comes with an opportunity, right? But
Yes.
we are still seeing the investment numbers down. That is why I've come. That is it.
That I would say that investment numbers. See, people are approaching, taking a wait and watch, because this is not like this. Like you are seeing unseen enemy, which behaves differently with each individual. Okay. So even though the business may be sound, they feel, but is it a short term? How much the visibility? When the next wave hits, how does it behave? So people are taking a wait and watch approach. I think the deal cycle would be extended. That's what. So people won't be simply rushing in, except for those outliers. Some of the big deals happening.
Okay.
Yeah.
Ashish is next, but Divya raised his hand. So Divya, you make your point, and then I'll come to Ashish.
I was just adding to Sajit's point. If you look at the last 6-7 months, I would say when the crisis hit all of us, the immediate focus of most PE and VC funds was a little bit inbound. Everybody was looking immediately at their portfolio, health of employees, liquidity of company, I would say then revenue, and last was profitability, pretty much in that order. And most investments that even happened in the private equity space, at least, were investments where people had done a bunch of groundwork pre-April, right? Where they had met, because obviously one core aspect of doing deal making in our industry is building solid relationships. And that, in a remote manner is not as easy. And last but not the least, everybody was looking for some stability. So I would expect some numbers on the investment side to catch up with another 3-4 month lag. That's just what has impacted us, I think, in the last 6 months.
Okay, Ashish, you have everybody's views in, and you can very comfortably comment on what everybody is saying. And I'm hoping that being X times, you will say something that will please the journalist in me. So
I wish, Alokesh, I could say that even for the sake of it. So as the earliest investors in the group, we come in very early. We are probably the first institution that comes on the cap table of a company. We start looking at businesses when they have reached a point where there is some degree of readiness on the product. And I would like to divide my comments on two parts. Yes, we are definitely seeing a very significant challenge when it comes to data on production on the ground level, manufacturing related information that we are all analyzing on a quarterly basis. But at the same time, I think we will also have to look at what are the things that are driving the markets. And markets is a function of the sentiments, more on the public side. But on the private side, it is more on the long-term conviction and fundamentals. The impact, whether positive or negative on the private side, will always show with a fair bit of lag, as Divya rightly pointed out. When we look at the challenges we are facing, some on the education side, some on the health side, a lot of these challenges probably have some or the other solution to keep things flowing. We went through lockdowns, we definitely had our own challenges, but our kids' schools are on. That is thanks to the virtual systems that we have. People are sufficiently entertained using media entertainment on phones. And okay, credit to our telcos and Jio for making the data rates what they are at. So I think
you finally said the name. Okay.
Sorry?
Nothing. Go on.
So when you look at holistically all of these factors, there is definitely a very strong degree of hope due to the formalization initiatives kicked off by the government. And when we all looked at the lockdown, the first lockdown coming in the end of March, I think we definitely took a fairly conservative view of the things, which is how it should have been. And now things are definitely behaving a little better than what one would have expected. So yeah, we feel comfortable about it. The fundamental challenges on the ground over the next 12 months are not going away. But at the same time, that does not take away the long-term opportunity that India brings to the table, both on the consumer side of things, as well as on the overall offerings that it has through its tech opportunities. We have seen the last years, Alokesh, that Indian tech startups have started to work on solutions which are global in nature, which was not the earlier wave that we had in startup side. The earlier wave was all about e-commerce, consumer goods, etc. We're now witnessing a more holistic and a balanced growth. So I think all in all, combination of factors does keep the overall conviction of investors alive. And this is both domestic as well as overseas. People definitely will not, in a hurried manner, continue to send dollars to India. But they will definitely not lose the fact that, okay, this is definitely a large market and a large talent pool that people will have to be a part of over the next decade-long story.
Right. In fact, that's a very, very positive beginning to this discussion that I was expecting quite the opposite. But it's good, then it means that we are all headed in the right direction, and hopefully the pandemic will not have as much impact as we had initially expected. Hopefully we are all right, and we are going to, the festival season sentiment and the numbers that are coming through now will sustain. I'll come to Alan, and Alan, you can give us a slightly broader perspective. There was this estimate that was put out by a research firm saying that, pre-COVID, Asian and global funds and LPs, they were estimated to have earmarked about $40 to $50 billion for possible deployment in India. And so we don't know whether that money has been put on hold. Is it being deployed in drips and drops? And so could you, from your position of being with, Intralinks, you give us a broader pan-Asia kind of sense of the PE investment sentiment currently?
Yeah, absolutely. And I'll give you that negative thing at the end, which you were looking for.
Good.
So across Asia Pacific, I oversee a bunch of different regions. The truth is that India and Southeast Asia are the ones that are hit worse. I'll get to that in a bit. But on the bright side, 2019 was a very good year for India. The amount of dry powder built up over the years, the amount of activities that hit in 2019. 2019 was a really, really good year, which kind of was a strong trampoline into 2020, only for everything to hit and stop. And yeah, the $40 to $50 billion in terms of deployment. We don't know, right? We can kind of see, based on what we're working with managers, that activity has picked up a lot, especially since August. So, fund deployment of dry powder has definitely picked up since August versus the March to August timeframe. So that might again, continue through the year's end. But the bright side is, the dry powder is there. I think it was, I think Ashish mentioned that, yes, money might not be pouring in right now, but the growth of the middle class, the growth of India's economy as a whole does mean that money is going to pour in over time. So in the short term, yeah, we might have some trouble seeing international investors, international institutional investors put money into India. But in the long run, I see Asia still as a behemoth. Right now, quite frankly, it's China, right? We say North Asia, but it's largely China, very largely China, which is driving a lot of this activity. They've gotten to the point where their own domestic market is big enough to facilitate, internal transactions without having to bring in external money, invest in external projects. But India has been seeing exponential growth, badly hit, I guess, March to August. But the bright side is, yes, we are seeing things pick up. Yes, we have the data that points that people are deploying the capital that has been built up over the years.
Okay.
You were looking for the negative thing, so I'll just mention that, right? And what we've been seeing, and basically what I've been hearing from fund managers in Southeast Asia and India, and I say these two most specifically because I guess across Asia, these two regions are the ones most affected by travel restrictions. India's very tight lockdowns, Southeast Asia being fragmented, right? So people can't actually meet even domestically or domestically within the Southeast Asia region between, say, Singapore and Vietnam. What we're seeing is the large funds are still doing okay. They're still raising capital. The smaller funds are having a bit of a hard time, right? Because they're not able to go out there and meet with new people. The relationships only go back so far. So while things are going up on the whole, like everyone has said, it's actually the big guns who seem to be leading the charge. And the smaller players are having, a bit of a struggle, what is from,
Okay.
what I've been told.
So maybe the big, the improvement in numbers is largely because some of the large players are still managing to hold fort in this crisis, which is interesting. So let's go a little slightly deeper into the impact of COVID, and I'd like to start this next round with Divya, and I'd like everybody to pitch in, and I think this is an opportunity for all of us to share an understanding of what really COVID has changed in terms of your approach to deal making. Has it changed following the COVID crisis? What are the factors that you are leveraging more on now? Are they the same factors that were prominent before COVID? Has the approach changed? What are you looking at when you are looking to invest now? Divya, you want to start?
Sure, happy to. I think let me start actually with what has not changed. I think most of us will agree that among the top three factors that many of us look at when we are looking to invest, first is industry attractiveness, the team, and then of course the valuation, right? So I think fundamentally, no specific order, but those points stay the same. I think where what has really, now if I get to the part that the core underwriting philosophy stays the same, we have the same amount of dry powder, we are actively looking to invest. What becomes a challenge in the COVID time is that when you are forecasting, say, the industry evolution, very clearly, when you're trying to look at industry attractiveness, clearly there is a digital first theme that's taking over many industries. And for us to do a medium to long-term forecast of how the industry would evolve is quite important for us to understand how the value chain will get impacted of the industry, how will the pie get divvied up. And that's something that we've been sort of building views on our core sectors for ourselves. And like I said, some industries are actually growing faster. Take health insurance, take term insurance, take broadband penetration, home education. The second theme is really around the business. And what happens, like I was briefly mentioning yesterday, during times of high growth, many sins of businesses get washed away. It's really when the tide goes away, the quality of the business, how best they can handle a crisis, the quality of the team comes through, the quality of the portfolio that they manage comes through. That actually is a plus point, because for the businesses which are managed better, it's relatively easy to understand the core quality of the business, which is always a very tough judgment call, right? Core quality of the business and the quality of the team. But I would say the challenge that when we've tried to forecast, and like I said, we do both short-term and long-term, is to the tough part in COVID has been to differentiate the short-term from the long-term, right? Will this crisis last 12 months, 24 months? What's the peak of this crisis? What's the GDP growth impact? How much of a tailwind versus headwind? I think those are the few areas where we've sort of taken some time, at least in quarter one, of this financial year. We were sort of grasping with that issue. So I think those are some of the aspects that we've been thinking about, how to pen down. But bottom line, as we are coming towards, at the end of the second quarter, we are seeing that the businesses run by high quality teams are coming to relatively unharmed. And in fact, market share growth is quite rapid.
Okay. In fact, businesses run with high quality teams is always one of the parameters that you look at when you're investing in a company, right? Vishal?
In fact, I think, Alokesh, I think what Divya made a very pertinent point. See, India has been a growing economy, right? And everyone, wherever we are investing, everyone is growing rapidly. In your quest for growth, there are some fundamentals about a business which gets ignored. So clearly, around March and early April, we were reasonably worried in terms of what would happen to the underlying businesses, what would happen to the balance sheet, and we just wanted to ensure that people have a stronger balance sheet. As we moved along, see, today under our portfolio, we are actively managing close to 23 to 24 companies, right? And as we moved along, we saw, every fund would like to say that all the companies are great and all the management are great, so will I. But we saw all well-running businesses and all great management. They kept on looking inward, and there are few things which were unthinkable. Let's say a lot of companies in the consumer space, they were doing some kind of ATL or BTL spending or some kind of incentivization where they were scared if they don't do it, they might lose the business. I think everyone said that, let's not be scared, let's go ahead and do it. And some of those things that they did, it positively surprised them. In fact, let me tell you, by and large, across the board, underlying margins of most of our businesses have been better in the first 6 months than what it was earlier. Some of that is temporary, some of them will become permanent. And as I said, some of these management inwardly thought what are things that they could do to create a strong organization in the medium to long term. And I think something of that kind happened in the last 6 months. And as they say, an event like this will separate men from boys. And for the quality see, I always feel, and I always say this, the stage at which India is, every product will grow because we've never consumed stuff, right? It's now that Indians are started consuming stuff across the board. You take electronics, for example, the amount of electronics that India is consuming is on the rise, right? Any product that you talk about, we are consuming. The differentiator is going to be the quality of management. Wherever you can back a strong management, I think they will create the magic very clearly.
Right. In fact, improving margins, I think this is the second time you mentioned it, and I'm wondering, I'll probably come back to you on that because improving margins is a good thing, but does that come with a fall in revenue as well? Because it might just be because of cutting down on your expenses and better cost management. That
as I said, some of that is temporary, some of that is more permanent.
Right. Okay. Sandeep, let's look at the venture capital view.
Yeah, so I was going to say that, through 2014, 15, we saw the growth of e-commerce. We saw a time when it was never a better time to be a customer. Between the discounts that Flipkart, Snapdeal, Amazon, you name it, and then any of the guys giving you deals on food, you could basically live for free over the course of weeks and maybe even get paid to do so. And I think that was all in the quest of trying to figure out how to change consumer behavior. And I think that in consumer tech businesses, that's a big part of it. If I open up a new coffee shop next to the current coffee shop, I have to give a discount to get you to come try my coffee with the hope that over time I'll start to increase my price and get you to pay the right price for it.
Right.
Now, what happened through COVID was it was sort of like the built-in forced change behavior. Suddenly you couldn't go out, so suddenly you had to try online delivery. Suddenly, for everybody who was skeptical about schooling at home or taking any class at home on a digital platform, suddenly they had to try it. There was no real question of, do I have to incentivize you? Do I have to get you to change your behavior? Now, once changed, and actually this is, I think, the critical part about this is, if your business is offering a more efficient and better way to have that product or service experience, and that is typically what most of these newer companies or tech companies, or even traditional companies that are using technology in intelligent ways are doing, they're actually making it a better overall experience for the customer. Their challenge has always been in creating awareness for that experience. And that awareness, a fair amount of it has been done. And once done, now there's a larger universe of people that are in the system that now other companies also have the chance to kind of vie for. If you kind of take the continuum, you have to first move people into a world where you want them to consume your product or service, and then suddenly they become aware of the fact that there are other products and services in that world as well. So I think that going forward, at least from my lens, this has, while an unfortunate incident in the overall scheme of life and everything else, has also played a critical role in accelerating a change in behavior. And I think that change in behavior will stick and will give us greater conviction, I think, going forward, in terms of all the growth that Vishal talked about as well, that's yet to come in consumption, that should come ideally in a digital environment, and that should come from people who have now already been educated by sheer necessity.
So Ashish and Sajit, I'll come to you with this question with the rider that, this change in behavior that we are talking about, how is that impacting your strategy in terms of investment? And do you think this change in behavior, like Vishal also saying that some of these things are temporary and some are not, do you, because if you change your investment strategy for the long term based on change of behavior that we see now because of the pandemic, that behavior might not be permanent, right, that change. So what are the factors that you are looking at now in terms of, your investment strategy into companies?
Sure. So, Alokesh, if I can just put it out from a perspective of an early stage tech investor like us, of course, there will be the growth investors will have their own set of priorities and changes. So I'll let Sajit answer that perspective. And so when it comes to us, I think initially there was a tendency to look at plans which were going to focus around solving problems which were around the virus situation. So you saw somebody who was trying to pitch solutions around health, or you were trying to have solutions around deeper engagement, because the virus situation is going to be a midterm problem. However, I think most investors would not focus on short-term or midterm problems. The obsession about going into very long-term problems which have a very large market for the solution to be adopted will continue to remain a priority. The only set of change that will emerge is everybody will ask a fundamental question that how is this going to sustain and scale with limited capital in the short or the medium term. There is definitely going to be a wait and watch or a look before you take the leap kind of approach by various people. And that is affected by various factors. As I was answering a question on the group, which was on the chat group, the overall deal making pace will definitely be a bit slower because in-person meetings are a big factor and driver for investors and founders to take things forward. But otherwise, I don't see very significant changes to way investments were happening. There will definitely be more question around how the businesses are going to scale. Once in every 3 years, we get into this phase where there is a fair bit of euphoria. And then we come back to a normalcy and start asking questions around unit economics and profits and cash and all that. This time around, I think at least the early stage tech investments are now, those which are more than 8, 10, 12 years old, will have to do well to take their portfolio or companies down the path of real exits, not just by one expensive M&A to another expensive M&A and merge and really make headlines. People will expect that with the turn of 2021, 22, 23, real exits, cash churning out will be there. So the short-term focus will be on that front. Long-term focus will definitely be a little more fundamentals driven and not for cash guzzling or cash burning businesses. Those are short term anyway. Most people would agree with that. So I don't think it's a pandemic which is affecting. It is just an opportunity to take a step back, reassess, and go further.
Okay. In fact, Sajit, coming to you, there is also a question from an audience member, Sridhar Raj, on this aspect, and his question is: can a once in 100-year kind of pandemic, the behavior change that is triggered by such a pandemic, can it be relied upon to build a business or even launch a startup? So it's more or less on the similar lines of what we are discussing here. What's your view on this?
Yeah. See, as far as venture capital investment processes are concerned, these processes like institutions in us are built over a period of time and learning, and these are almost like it doesn't change overnight. It doesn't change. Right. Only what the COVID has made is basically you add a layer to it of granularity on the quality of revenues of the prospective industry companies. Now, we are primarily in the MSME space. Now, here businesses can change overnight and do X, Y, Z. Now, there have been instances where we have come out, say, suppose we are looking at small textile companies, etc. Overnight, their revenues look good, performances look good, but when you dig deeper, it is on making something, a face mask, let's say. The numbers are good, but is that a long-term perspective or is it short-term just for the pandemic is over, that business is over? I mean, this is a permanent change. Correct. Similar kind of things. So we do look deeper into that. One more layer we have added. Vis-a-vis last year, where they are on a revenue front, where are they similar revenue numbers? Have the recovery happened on a month-to-month basis? As April, May, everybody understands. Post that, how are they? Are they 40% less? Are they at par? Where have they reached? So that on a month-to-month basis, we look granularly. And also, if there is a change in the business model, quality of revenues, is the churn in the customers, why the customers have gone away, or a new set of customers, or change in the business line itself, is it a sustainable kind of a thing, or whatever aspect their efficiency, is that sustainable? And obviously the other things already in the standard list is taken care of, like the viability of the market, etc., is taken care of. So that's the way we are looking at it. I think, see, this process is perhaps this will get embedded into the press process or existing processes going forward. Whatever granularity learning over these 6 months when we are looking at cases and we get surprises. See, this process will get more strengthened and some of these learnings get embedded. These are not short-term processes. So when you look next year also, perhaps this level of granularity will remain in our processes. Okay. Something which may have been missing earlier. Yeah.
Okay, that's good to know.
Sorry, Alokesh, I was just going to interrupt. I was going to say that, this question of what lasts, I think that if you go back and look at, like when we had a lot of when 9/11 happened in the US, or the terror attacks here happened at 26/11, there was a certain shift in mindset towards the importance of security. And today, you don't think twice about walking through a 5-star hotel and going through a security process to get in, and it's become a part of life. I think that going forward, the idea of transparency and hygiene are going to be very important in how products are built and how services are actually given to people. We're going to want to know, how many people touched this before I got it? Is it, how well has it gone? And I think that those will be transparency and hygiene will be two factors that businesses will have to incorporate into their ongoing operations. I think longer term, and I'm hopeful, quite honestly, longer term, that things like sustainability and provenance. So where exactly did this product come from? I want to buy something that's local to me. I want to feel connected to the area. I want to buy something that's better for the environment and the earth. These will hopefully be underlying trends that, unfortunately, I would imagine another large event will have to bring it up to the front again. But at least coming out of this, I think that businesses that can start to adapt that mindset and have those functionalities and features in mind, I think will serve them well.
Right. In fact, we've noticed that during the course of this pandemic, there have been consumer goods companies, FMCG companies that have launched sanitizers, they've launched masks. It's a new line of business, sanitizer. But what happens to that new line of business once the pandemic gets over? Who's going to buy the sanitizers? So what happens to that line of business? And
actually, sorry to interrupt, but my point is even broader than other lines of product. I'm saying your existing business has to adapt hygiene and transparency in a bigger way. So whatever that might be.
Absolutely. That is absolutely essential. You're correct. And so that brings us to the aspect of what are you really looking to invest in, currently, in terms of your assets. So for if we look at 2019, almost 80% of VC investments came in technology, whether it was consumer technology, whether it was SaaS or fintech or B2B commerce or B2B tech, right? And almost 71% of PE investments in 2019 and 18 came into infrastructure, financial services, real estate, e-commerce. These were the hot sectors at that time. What's it going to be like in 2020? Are you going to be looking at this? And we have a good mix of PE and VCs here on the panel. So it will be interesting to see, what are you looking at now? Are you looking at much the same thing as before? Are you looking at new sectors? Are you looking at, for example, there's a question from an audience member who says, are you going to be looking more at COVID products, right? What's going to be the investing trend? Pratik Arora is asking, will the investing trend focus more on solutions related to COVID, or will it be hardware or software technology? So interesting area to discuss. And Ashish, you want to start?
Yeah, happy to go first, if that's okay, Alokesh.
Sure.
So I think, Alokesh, I think, like I said earlier, it will not get down to focusing on things which are likely to not be there as a problem beyond the next 24 to 36 months. The COVID situation, we are all hoping for, and there is enough comfort that hopefully over the next 6 to 9 months, there will be a visibility on the virus and vaccination for a significant part of the population. It may take much longer for the whole population to get vaccinated. But even then, the problems associated with COVID, some of the ground level challenges on health, etc., are of a medium term. But it has thrown a few interesting behavioral shifts, like Sandeep was mentioning earlier. I think Sajit also referred earlier. Almost everybody has spoken on that. On that, of course, there will be avenues that are open. For example, the world has realized the fact that when it comes to getting or teaching or coaching, that things can happen online. So there will be an orientation to build startups around education, not only just coaching over Zoom call or a virtual call, but around building the ecosystem for education, training, coaching, etc. Whether it is for K-12, whether it is for grads, post-grads, everything. So there will be definitely areas around that which will get a deeper attention. There will be a greater need for things like cybersecurity. The digital transactions thrust has always been on. What COVID did was it accelerated adoption of many people as a consumer onto the platforms. Those who are not going and buying grocery online suddenly are now online. Those who were used to only going to a bank and transacting have suddenly not only banked online but also paid their insurance premium, bought their next mutual fund, everything. People have suddenly got a flavor. So there will be a thrust to build a greater architecture or infrastructure because of the semi-permanent increase in the number of consumers that have come online, and most of those consumers will be continuing to transact there, is the belief. Of course, not that the retail stores are going to go away, but they will have a different way of engaging with the customer, and both will coexist. So there are interesting opportunities and models that will come when you look at behavioral patterns. But to believe that it will be centered around the pandemic or the virus, I don't feel so.
Okay. And Vishal, I think, did I see you raise your hand? Yeah.
Yeah. So, I think we've been a growth capital investor, and a lot of our investing style has been bottoms up. We have our own internal philosophy, which is called the QGLP, where we try and look for good quality businesses backed by great managers, where we can form a view of growth in those companies. G stands for growth, L stands for longevity of that growth, and P stands for buying it at a reasonable price. So we have this framework which we call QGLP, and we have some preferred sectors like consumer, financial services, and pharma. And after that, for us, it's more of bottoms up analysis. So honestly, at the core of what we are, nothing changes, right? We are investing with 8 to 10 year mindset. And another philosophy that we have is to invest in businesses that we understand. where we have a circle of competence. That does not, so for example, we've never invested in an e-com. Does not mean it's a bad uh, investing firm, but it's something that we don't understand. So we all have we are more of someone who needs to feel something, brick and mortar. Obviously, COVID also will force us to make some changes. As an investor, we have to keep on learning and upgrading ourselves at every point in time. For example, we invested we typically would invest in a company which would have some revenues and profits. We invested in a company last year called Mall Biodiagnostic, which had a 50 crore loss. And today, let me tell you, close to 40% plus labs in India where COVID test is happening on the equipment which has been designed by this company. So clearly that change did bring in an investment which hopefully should do very well. But clearly at the core, nothing much changes from our standpoint. But as I said, there's some businesses which we feel will not be able to form. So let's say something to do with travel, something to do with retail. Obviously, we know those businesses are going to be there for long, but maybe in the medium term we might not be able to form a view. So we'll look at some of those businesses differently, but otherwise, because at the end of the day, we are investing with an 8 to 10-year time frame, and their idea is to back fundamental businesses backed by great entrepreneurs. And wherever we can do that, we will. For example, there is some bit of uncertainty in the lending space, but we know that is short term. Eventually, in the medium to long term, lending businesses are here to stay. And then we are quite bullish, and looking at opportunities everywhere around us. It's just that we are not finding enough, and clearly because of the travel restrictions and all, deal making is taking that much longer, and companies themselves are at this particular point in time thinking less about fundraising but more about tiding through this phase. So we'll wait and watch. Hopefully 6 months down the line, we'll see a much more vibrant deal environment.
That would be what we would look forward to. And you did mention a little bit about investing in healthcare and life sciences kind of companies. And
right.
If there's anything, Divya, I'll come to you on this. Is that you could also tell us, your view on what are the asset classes you're looking at and whether they're different. But I'd also like to ask you as sort of a supplementary on that. And in fact, there is another question from Bala Bhumidi from the audience who's asking, what are your thoughts on biotech startups, which I'll ask the VCs also. But what I wanted to come to you also, because a pandemic is where the pharma company is the star, right? Everybody is looking up to the Pfizers and looking up to, now we have the Bharat Biotech and other Indian companies who are developing their own, vaccines, and hopefully something or the other will click at some point. Are you looking to invest, is healthcare, life science, biotech, is that an area that you would look at? Now, education, of course, is very big, like Ashish said, and we have been seeing lots of investments in Byju's and in Unacademy and the others. So, your view on this, Divya?
Sure. I think what Vishal said to a significant extent would also be true for us. The four sectors that we focused on historically, FS, consumer, tech, and pharma, or they've taken 75-80% of our investments. We are sort of focused pretty much on those. To your point, when I say pharma, I meant healthcare. Within pharma, we are actively looking at a whole range of things. Of course, there is a certain degree of it's relatively easier in pharma to forecast the next 12 months than some of the other industries, and that's also helping us. To build a point of view on that. But we are, as we speak, engaged in some of those conversations. And of course, these are early stage conversations. We will see how that goes. Similarly, in tech, more in tech services, not necessarily, to the earlier point, some of the businesses which have emerged or the $1 billion plus businesses, the way I see it is that they've completely skipped the private equity stage, or they've gone from the venture stage to the large, super large valuation ticket sizes. So, but that may or may not be for investment firms like us. But we've been looking at tech quite actively, and as we speak, again, we are engaged in some conversations. On the financial services side, where one could argue that balance sheets are a bit broken, and it's also not so easy to forecast, I would say that on the lending space, we have actively looked at how businesses have performed. And I think what our yardstick has been is that, the whole thing that we say that if the industry is sinking, are you swimming? And if everybody is swimming, are you flying? So the differential performance argument is coming through quite actively. And the managers that are winning in the lending space, we are again having active conversations, around that. And the good news about deal making in private equity is that there are ways to manage the pandemic risk, when you are investing. So all in all, I would say that while the last 6 months have been a bit quieter phase for us, but I do expect the coming quarters for us to be relatively active.
Okay.
I'll just add one more thing. One of the areas that we are definitely seeing right now is a little bit on the manufacturing side, particularly on two areas where India is going to be more self-reliant. For example, electronics as a space, maybe around $55 to $60 billion of electronics, they get imported into India. And that is exactly what is India's current account deficit right now. And given the initiative of government of being more self-reliant on the electronic side, I think could be a huge play. And that is, we have done some investments there already. And some bit of areas which is around alternative to China, both domestic as well as exports. I think these are some interesting opportunities that will emerge on the manufacturing side. Manufacturing is something which was completely ignored as far as India is concerned last 10 odd years. I think if we get our act right, and I'm hoping this time we do as a country and as government, then manufacturing, both in terms of self-reliant and secondly in terms of exports should definitely be a play that is there, and we as a fund would like to play some role in that transformation.
That is very good to hear, from a private equity leader like yourself on this, because we've had a few manufacturing discussions and we were all wondering 25% of GDP kaise hoga? How are you ever going to reach there? It needs a lot of money, lots of investment, and lots of higher productivity. And
we as a fund have somewhat of a dream at in next 10, 15, 20 years, can we make this electronic import, which is a wasteful expenditure? See, it's the third major item after oil and gold. Oil, we have no choice. Gold is still an investment. You're creating an asset. Electronics, when you're importing all these equipment, mobile phones and all, and you're changing it every 6 to 12 months. I think it's a huge drag as far as country is concerned. Absolutely. If we collectively can play a role, government, investors like us, and opinion makers like that of yourself, in terms of doing that for India, I think we should do it.
Right. I'll come to Alan after Sandeep. Sandeep, you have been waiting for some time. And Alan, I'll come to you for the Asia view on this.
Yeah, Sandeep. So I was just going to add the thought that, when we started investing out of our third fund in 2018, and again, our focus is consumption. We said that the two biggest threats to consumption going forward were going to be environmental issues and social issues. And you had at various points in time, people in Chennai fighting over water. You saw that in South Africa. You have underemployed people. You have millions of people operating, standing in line for thousands of jobs at the railways. And this becomes a big problem. And so if we think about the business models that are going to come ahead and how we are going to encourage consumption in this country moving ahead, there's an interesting stat that came about that said that if the rest of the world consumed the way the US does, we would need 7 planets to support that consumption. And so now you put that in perspective and you say that the vast majority, as people have talked about here, are now just moving into consumption, are now just thinking about how they want to move from sort of needs to wants. And you say, okay, look, can we frame that in the right way for them? Can we create businesses and brands that focus on building consumption in a conscious manner? So I'm not saying we're an impact fund. I'm not saying we're a green fund. We're not a social fund. We still need to make a profit. But I think that we can be very mindful about the direction we give the businesses that build, and how we measure them, and how we actually evaluate what models we want to create. For example, fast fashion as a model tends to create a ton of wastage. Straight to the point where certain brands will literally burn, light on fire, excess inventory because they don't want it sold in the secondhand market. Now, you have that type of a business model and that type of business sense running. And on the flip side, you can look at models that don't propagate that. You can look at models that probably focus a little bit more on slow fashion, that ensure that people keep their products longer. And these are not new concepts or new thoughts. They've just kind of sat to the back while everyone has focused a little bit on another side of the equation. I think these are going to come to the forefront. And I think that, as I think Vishal was talking about as well, whether it's from manufacturing, creating businesses that can meet our local needs, to then thinking about export. I think some of these models that we're going to create out of here, and we're already seeing it, whether it's a business like Rebel Foods, which is cloud kitchens now expanding across geographies in Southeast Asia and in the Middle East. And we'll see it in some of the other apparel related businesses as well that we're looking at. I think that there's going to be a massive opportunity to take the uniqueness of India and the unique dynamics that exist here, build models that are constructed without the legacy of incumbency. I don't have to compete against shopping malls that have existed and been the main driver of stuff. I can go direct to the consumer with my brand, change the margin structure of channels. All this is possible here. And then look at perhaps taking those models into other markets as well. So I think that at least COVID has, in my mind, all it did was accelerate underlying trends. It's a very unfortunate way to accelerate the underlying trends, but it did accelerate underlying trends. So at least from our lens, we'll continue to look for these types of businesses that we feel fit well into this zone of being able to deliver the right products in the best way for the world.
Right. And, before I come to Sajit, I'll just come to Alan. Alan, you can give us a little bit of sense of, where you see this asset class investment trends, some asset class investment trends that you can talk to us about on a broader beyond India kind of scope.
Yeah, totally. And in a way, as all the panelists said, I think India mirrors what's happening globally now. Tech, e-commerce, that's been all the rage. That's something that everyone's been looking at. I think that euphoria, that interest in tech investments has kind of waned in the past few weeks. Now there's a shift more towards the undervalued stuff. So in India, I know infrastructure, your REITs, real estate products, these are things that people are turning towards more of a focus on. And again, this is just short-term behavior because, and I can't remember who now, but I think 2 or 3 of our panelists today, we mentioned that long-term wise, that's not going to change, right? Long-term wise, people are still going to look out for what, makes the world a better place, where the world is trending towards. It's going to be those things that will ultimately drive value in the long term. Short term, it's been tech, it's been lending, it's been life settlements. Post short term, I call this the second short term. It's now undervalued assets. But then at the end of the day, it's going to default back to what will drive the world, what will drive trends globally. So that's, I think what investors will be seeing. That's what trends have been pushing towards, in India, as well as the rest of Asia Pacific. China is a bit of a strange example. We've seen some huge IPOs. The bottled water IPO, which
another
made
one's coming up soon.
Yeah, the founder richer than Jack Ma. We've got another one coming up, I think the 5th of November, and Financial. We've had 2 electric cars go public in the past quarter. So China is a very different market. I think if we take China out of the equation, the rest of Asia is, still a bit quiet, still a bit sitting back on the IPO market, because again, there is some uncertainty within the local investment regions, but we go back again, defaulting back to public market funding is pretty much saturated now. So private market funding is really back in the picture, and that's something that investors are turning their focus back on.
Right. So I'll come to Sajit, and Sajit, just to add a few things, that there are lots of questions coming in from the audience, and it just mirrors, what the people are thinking. And many of these people who are asking the questions are also, of course, startups and all themselves, and they want to know what are the prospects of the business that they are doing in. So, there are some questions regarding telemedicine and health tech companies. Do you see investments in telemedicine startups or health tech startups or entertainment and event companies. Do you sense that the investments in these sort of businesses are going to rise, apart from your own view of what are the businesses you're looking at?
Yeah. See, we have been typically, like I said, we are primarily in the MSME sector, and we have typically invested early stage companies. And throughout our 2-decade experience, whenever we started, we invested, we went to some of the difficult areas. When we went in 2000 with the first fund, we did a substantial amount of software product companies, which was not the theme for other people those days. And we made a few successes out of them also. Similarly, 2013, we did one of the first impact investment funds out of India. So that also has gone and invested in green energy kind of projects, solar powered solutions for the lower income households, or water solutions, or even providing finance. Is basically the poor as benefits as a consumer or a producer. That was the basic theme of the fund. We have had good success in those. See, and all this put together, what we have noticed is ultimately the consumption is the key. India is a big market. Aspiration levels we have seen changing over this last 2 decades. People's wants and needs have changed. The lifestyles have changed, and it is accelerating much faster. The core thing is consumption, but still the overall system ecosystem. We were, and another thing, we were large investors in the manufacturing space also. We have taken bets and we have lost money also in that space. But what we've seen is the quality is one aspect, or the efficiency, productivity. These are challenges which are still to be addressed. And we see space in that. And technology would definitely add the necessary pieces which will build in all this and give the consumer a very good, better product or better experience, overall experience. So our focus is what we've been going forward is basically around the consumption space, but more technologies or units which feed into this and make the overall experience for the consumer better. That's what we see. And coming to the health tech and all those things, telemedicine has been around, and there are too many players around in the market. What we have noticed is to really make an assessment of that, is there too much money chasing or too many Me Too players, or we'll have to figure that one out. Is it too many players in the same, going after the same pie kind of a situation? So that is what we have to assess. Yes, there will be opportunities. There will be a differentiation. Something I saw investment recently, Techion, the recent investment which went $1 billion in unlisted space. I could never imagine a business like that, wherein the experience of buying a car is totally differentiated and it's valued at such levels. So let's see, there could be opportunities within the same space, discovery, and a differentiated businesses always. We are anyways open to. We are sector agnostic and we are open to looking at any business. But we will see what's the innovation and the differentiation in the overall before taking.
Right. So in fact, before I move to the next question for the panel, I have a quick one for Sandeep. And you were speaking about, doing the right things and making sure, we are concerned about products being handled in the right way and all. And there's a question from Atul Sharma who says that, has the ongoing COVID situation changed perspectives on profit versus impact? And do you see a rebalancing of priorities?
Yeah, it's funny. I was on a panel on another conversation where we were talking about impact versus profits. And I think that, look, honestly, to make the impact sustainable, it's got to be done in a way, in a business model that's actually also sustainable. So the idea of rebalancing is less the view in my mind. It's more a recognition that the fact is that you have to do this and it's good business to do it. There's a company that's and a founder that's written a great book called Let My People Go Surfing. It's a Patagonia story. And Patagonia, as a clothing and apparel brand, talks about the fact that their underlying fundamental North Star in their business is leaving the earth a better place than they found it. And as they've done that, they've actually built a very good, very profitable, very well-recognized brand, a very good, very profitable business and very well-recognized brand. So I don't know that it has to be such a trade-off. And I think that it's too often put in that framework that says that either do good or make money. And I don't necessarily believe it needs to be that way. I think if you are going to figure out how to ensure that you're delivering customers a product at a price point that they want while ensuring that you're not negatively impacting the world, because I'll actually put it this way. I think that if it's not happening blatantly enough in people's faces today, over the coming 5 years, what you'll start to see happening is a component of the brand that people are going to look for. And let's just say that part of that brand is creating aspiration. A part of the aspiration is what can that brand make me feel like? What club am I going to be a part of? But I think going forward, a part of that brand's aspiration is also going to be about saying, what are you doing about the world around you? And what are you doing to make the world around you better? And how are you not messing it up? At a minimum, how are you not messing it up? So if you take that into consideration, you then start to imagine and hope and extrapolate that the investments that you're putting into ensuring that you're making the world a better place will reduce the cost that you'll need to spend on marketing or retention. And so that should ensure that your profits are actually not impacted. So I would tend not to look at it as this or that. And I would tend to try to ask that it actually be integrated into a business. And I think that with doing that, you will see the benefits ideally in the medium term.
Divya, did you have something to say on this?
No, I was just doubling down on that point, that I think it's very critical to actually get both of those right. One is to build businesses the right way. And second is to obviously deliver winners. And I think our country, frankly, can do with a lot more combined stories. And I also agree, it's not one or the other. And increasingly, we are seeing, in a lot of businesses that we are meeting, that there is a surge of energy and entrepreneurship, which is helping us achieve both.
Okay, that's terrific. Somebody wants to add something to this? We move to the next question otherwise. Okay, so we are at 4:45, so towards the closing stages of this discussion. The one thing that I really wanted to know is, are you able to raise funds for your funds, as easily as before? Because the numbers are painting a different picture again. It says that fundraising in Q1 in India fell 94%, right, to 171 million YOY. So that is like really astounding. And we normally expect, players like yourself to be struggling to raise funds, or are you really not that concerned about it? Are expectations from LPs also changing? Do they want more transparency? Do they want better, deeper understanding of, portfolio allocations? What is, perhaps you could just educate us a little bit on that. Ashish, you wanted to start?
Happy to go ahead. So I'll take your question in the two parts that you mentioned. The second part first. I think LPs have always been insisting and pro transparency, governance, etc. If you look at the trail of funds that have done well, raised successive rounds of capital with validation from existing LPs. So I think that's not changing. That's only increasing, like you pointed out. And most of us on this panel would have increased their interactions, if I may say, with the LPs in terms of keeping them posted on what's happening in the portfolio and giving them the right degree of comfort if things are going well, or announcing, like for example, we are an investment vehicle where there are early loss ratios are pretty high. So we would definitely do well to inform them and keep them posted a little ahead in advance given the nature of the situation. So the expectations of the speedier communication definitely are on the rise. But broadly, overall, I think the fundamental pillars of governance, etc., remain. On the previous part on fundraising, we've tried to take a very simplistic view of life. We are raising perpetually. It's just a different issue that once in 3 years you're raising for ourselves, other times you're raising for your portfolio. So, and the trends that we have, if trends are anything to go by, I think it's a mixed bag. It will definitely not be at the same breadth, because like it is for startups getting funded or private equity funds funding growth companies, it's true with LPs also. The whole interactions in person, the ability to interact over multiple rounds of discussions, meeting all the partners in the team, at least all the investing leadership of the team is important. So I think for bulk of the period in the lockdown, the first 3-4 months, we were shut out from travel, etc. And even if we do now, I think overseas guys definitely are going to be skeptical in meeting people. So I think until those realities change, it will definitely be slow. But I want to highlight one thing, that domestically, I think the markets are realizing, investors are realizing the fact that where there is a right proposition on the alternative side, whether it is combined by tech or something which is fundamentally differentiated, backed by a strong manager, the opportunities will be received well, is my strong belief. We have seen some positive trends underlying on the tech side when we have been talking to some of the potential investors, etc. But it is slow than normal for sure.
Okay.
Alokesh,
Yeah, I
we
saw
have
a
to understand.
broad smile on you, Vishal, when I was asking this question.
Alokesh, we have to understand. People are not stepping out of their homes.
Yes,
Okay,
true.
people are not meeting friends. People are not eating out. People are not doing anything. They're shit scared. They're sitting at home, right? In midst of this, you are worried about PE investing. You're worried about fundraising. You are worried about exit. अरे पहले लोगों को घर से बाहर निकालो. लोग बाहर आए, घूमें. People are
Sir,
not
हम तो
stepping
सबको
out.
बाहर ही
People
भेज
are not taking. People are not taking a plane to go anywhere.
Yeah, that is
People are
true.
not eating out in a restaurant. I wanted to take my wife out and go for a lunch to a restaurant. My parents stopped me from leaving the house. How will that restaurant do? How will that restaurant make money? It will not. So let us first bring life to some bit of normalcy, right? This scare of COVID, yes, COVID is there, but we also need to fight this thing out while being careful about it, right? And slowly and gradually people are doing it, but I think it will still take some time. And once that is done, we'll worry about fundraising. But on a serious note, next year is the year when we are going to be on road to raise money. I hope by then a lot of these things should be behind us. But more importantly, I think it is important that we take all precautions and we start moving towards leading a normal life.
Yeah, in fact,
If not for ourselves, for the economy, and then this whole circle, which has become a vicious cycle now, can become a virtuous cycle.
yes, in fact, and your point is very well mirrored by a point that one of our audience members, Pratik Mittal, makes, and where he says that retail is going to be in distress, no matter what, because people are just not going out, not spending, so consumption is down by at least 40 to 50%. This is the estimate, So, Alan, I think you had raised your hand, right? If I did not.
Yeah. Just wanted to chime in on one thing, and just adding to Vishal's point, nothing is normal now, right? Seriously, nothing is normal. People keep saying we're in the new normal and all that kind of stuff. So I want to just address the thing around transparency. So for the most part, because of this not so normal times now, people aren't able to have that water cooler chat. They're not able to have the fireside chat with the manager. They're not able to go out to a restaurant and even meet with the manager to place their investments. So what that's pushed people to is more fear. That means they need more transparency. GPs are being forced to produce more materials, share more materials than ever before. Existing investors are demanding that more than ever before. This is not just in India, but across the whole world. So your question around transparency, I think that has been something investors have always wanted for the longest time, but this year has really accelerated that demand from investors.
Right, and this question on, we just like to take that to Sajit and to Divya also on fundraising. But Sajit, I think for SIDBI Venture Capital, it's not much of a problem, right?
No, that's not the case. COVID has just has generally put everything on hold. I mean, we have been raising funds from the domestic institutions. It is not from SIDBI. Our funds are raised from domestic institutions and banks, insurance companies, etc. And what we noticed is that over the last few years, their processes have improved quite a lot. The granularity of data they seek have improved, and they themselves have set up in-house processes. And one more thing, which is that those institutions have taken exposure in a number of funds. So their knowledge base also has improved. And that also impacts the performance of the whole basket, impacts their decision going forward. In the current situation, the COVID situation, and whatever these institutions have been going over the past couple of years, has put perhaps the private equity venture capital exposure at the bottom of the ladder, and COVID more so. So right now, even this, the first 6 months of the year is a period when most of these institutions call us for a review meeting, face-to-face meeting, to understand the portfolio, how the fund is doing. We spend typically a couple of hours with these people, most of the institutions. But this year, nothing has come so far. Whatever questions are remote. Even if you ask for a face-to-face meeting, no entry allowed.
Yeah.
So the best, the most nearest you can get is through if you can get over a Zoom call. And that too, I have had instances when I have set up a meeting and then came to know the person has fallen a victim of that kind of situations also. Because most of these bank institutions have necessarily worked through this period complete, and their exposure level to this COVID has been the highest. I mean, they have taken maximum number of challenges. So typically we fall lower in the rank. Private equity, this kind of business, they have more challenges too. So COVID situation is definitely difficult. Their processes have improved over a period of time over the last few years. There's a dedicated desk. They understand the space much more, and they ask more relevant questions now rather than a few years back. That's it.
Yeah. Okay. Divya, just to come to you, we are almost over in terms of the time, but there was a point you made about this about a crisis bringing forth the best investments, because then you are able to realize better returns later. Do you think this coronavirus pandemic is also going to give you and other the P and VC industry that kind of opportunity? And do you see that kind of aggressive deal making happening despite the problems that Vishal and Sajit talked about, both in terms of fundraising and investment? You're not able to step out, not able to go and meet people. How do you invest in a company when you have not met the management and got a sense of the person across the table, right? Do you expect this crisis also to result in that kind of aggressive deals?
Absolutely. I think, firstly, Q1 of this financial year, I would have said that as most people were focused on their existing portfolio, the investment pace would have massively slowed down, new investment pace in India. And here, obviously, I'm not counting the public market, large cap bank capital raises or capital going into geo, keep those two outside of this bucket. But I think from Q2, I'm sensing both in our internal conversations and in the market that the conversations are genuinely quite live, quite active. We recently raised a fairly large round, $100 million plus round in a lending business of ours, which, while moratorium was on. So that gives you an example that people are right now placing bets in even lending businesses and moving on them. Likewise, we are doing the same. So I absolutely think that this is sort of the low point of the crisis, at least from a health impact and the economy GDP impact is behind us. So to that extent, the number of calls that people are willing to take, given that most of us are long-term investors, is actively increasing. And I was giving you two examples of the last crisis, which was not of this nature, but at least when demon happened, I think, month on month GDP was falling quite quickly. And the investments that we made, as we look back, we are doing quite well on them. So likewise, I do expect in the coming months, I think a lot of firms to sort of use some of the dry powder.
Okay, thanks. And unless somebody has a point to make, I will start the wrap-up process. There was a very interesting question that has come, and like a true journalist, I'm positively skeptical about it. And the question is, what do you feel about India now? India reaching $5 trillion economy by 2024. Do you think that's possible? Maybe a quick comment on that before I wrap up. Who wants to take that? Sandeep? Since nobody volunteered.
All right. I think it was challenging in the best of circumstances. I think that, look, I made the statement earlier that things tend to move gradually and then suddenly. And so I would be hopeful that the things, the combination of people like, let's say, private equity players interested in investing in electronic manufacturing, the ability to start to look at other parts of the economy contributing and consumption growing in different ways and exports being a part of it. There are so many pieces that need to come together to make that happen. I think that it's one of those goals where you shoot for the moon and you'll land somewhere really high. And I think that that's a nice aspiration to have. And I'm hopeful that we'll get someplace really good with it. And so I wouldn't want to change the dream. I would just want to continue to try to find ways to get as close to it as possible. And I think along the way, we'll create some really positive movements.
You know, I think 5 trillion will happen. Whether it will happen in 24 or 25 or 26 is not important. What is important is whether we as a country are doing all the right things to reach that $5 trillion, you know, and as long as we are creating a right ecosystem for entrepreneurs to flourish, for long-term investors like private equity and venture capital to flourish, I think that number will happen. I think the journey or the process is more important than that number in itself, because you reach 5, your next goal is going to be 10. You reach 10, your next goal is going to be 20. What we need to answer is that over the last 3 to 5 years, have we done right things as a country, as an ecosystem, as policy makers to create a thriving environment for the Indian entrepreneurs? The answer could be a mixed bag. So let's hope that changes.
Yeah, let's hope that changes. And in fact, some of the things that are changing are not quite so comfortable as well. You know, like I was coming to office this morning, and when I do these webinars, I have to come to office because of the, you know, stability of the connection, the internet connection, because that is what the whole thing depends on. And there was this conversation going on FM radio, where the radio jockey was saying that, you know, there are people, she went out and met some people and asked them, you know, what do you, has the fear of coronavirus gone away? Because at least when I step out, I see lots of people without masks. You know, they're sitting next to each other, chatting away like nothing has happened. You know, and the crowds are almost back to normal. And most of the people on radio were saying, yeah, you know, the fear of corona has gone. But the fact remains that corona has not gone. You know, the fear may have gone, but corona has not. And like Europe is saying, there's a second wave that's already there in Europe. And the first wave has been bad enough for India. What doesn't know what, if a second wave comes, what it's going to look like. Hopefully things will improve, and hopefully the positive vibes that I have got, you know, we've got from this discussion today will all turn out to be true, and we will move forward in a positive way. I would like to invite Alan to just summarize the discussion and propose the vote of thanks.
Sure. Yeah. Thank you, Alokesh, for hosting this event. You know, first of all, thank you to Sandeep, Divya, Ashish, Vishal, and Sajit for you know, all your insights. I think it's a very strong panel we have today. So the audience and I, you know, and Alokesh, we've all been able to have great discussion. And you know, last but not least, a thank you to the audience, you know, for making it out today. Hopefully, you took a thing or two away, you know, from this very engaging time. Overall, you know, everything sounds bullish, which is always great. You know, there's a lot of positive sentiment. I think, you know, in a recap sense, we are not going to let things change, you know, our investment strategy. We're not going to let, you know, the situation make us jump into short-term measures while forgetting the long-term goals. So, you know, as Vishal, you mentioned, you know, we are going to get to 5 trillion. It's a matter of when. It's more of a matter of how. You know, are we doing it the right way? You know, and I believe we can. You know, we've turned the corner per se in most regions around the world. Unfortunately, some have taken a step back, but at the end of the day, you know, this will be a catapult into, you know, whatever the future might bring. And I think for managers, investors, and the general public alike, it will be something we'll look back on and just, you know, become stronger.
Okay, we'll do the group photo now. You remember I told you about it yesterday. So everybody look into the camera and smile. Nidhi, tell us when it's done.
Done.
Okay, done. Thank you so very much,
Thank
everybody.
you.
Thank you.
Thank you. Thank you.
Thank you. Thank you.
Bye, Divya. Bye, Sandeep.
Thank you, Alokesh.
Bye.
Thank you.
Thank you. Bye.
Bye.
Thank you to all the people who attended.
Thank you, everyone.